Welcome back to Mastering MHAMBA. Today we are exploring Chapter 3 Cost, Volume, Profit Analysis, adapted from Managerial Accounting, Making Decisions and Motivating Performance by Datar and Rajan, published by Pearson Education. This chapter explains one of the most powerful tools managers use to understand profit behavior, how costs, volume, and prices interact to shape financial outcomes. Learning objectives. In this lesson, you will learn: first is the meaning and features of CVP analysis. Second is the contribution margin per unit, and the contribution margin percentage. Third is how to prepare and interpret a contribution income statement. Fourth is how to calculate the break-even point and target operating income. Fifth is how income taxes affect CVP decisions. Sixth is how managers use CVP to evaluate decisions such as advertising, pricing, and target profit. Seventh is how sensitivity analysis and margin of safety help us risk. Eighth is how different cost structures influence operating leverage. And ninth is how CVP works for multi-product, service, and non-profit organizations, ending with contribution margin versus gross margin. Section 1: Essentials of CVP Analysis. Opening story. Imagine a hospital considering whether to invest in a new CT scanner. The equipment is expensive, but the hospital expects patient volume to increase. Before committing millions of dollars, leadership needs answers. How many scans must be performed to break even? What price must be charged to earn a target profit? How sensitive is the project to changes in demand? These questions are answered using one tool: cost, volume, profit analysis. What CVP analysis examines. Cost, volume, profit analysis examines how total revenues, total costs, and operating income change as output changes. Managers use CVP to understand how price, volume, variable cost per unit, and fixed costs interact. CVP is a planning model that helps managers anticipate financial outcomes before decisions are made. Contribution margin. Contribution margin is the cornerstone of CVP. It equals total revenues minus total variable costs. Contribution margin shows how much is available to cover fixed costs and contribute to operating income. A higher contribution margin means more flexibility and greater earning potential. Contribution margin per unit. Contribution margin per unit equals selling price minus variable cost per unit. This tells us how much each unit sold contributes toward fixed costs. For example, if a medical test sells for $80 and has variable costs of $20, each test contributes $60 to covering fixed costs and profit. Contribution margin percentage. Contribution margin percentage expresses contribution margin as a share of total revenues. This ratio helps managers compute break-even revenues and understand profitability relative to sales volume. The contribution income statement. In CVP, we use a contribution income statement that groups costs into variable and fixed categories. Revenues minus variable costs equals contribution margin. Contribution margin minus fixed costs equals operating income. This structure highlights cost behavior, the driver of CVP analysis. Expressing CVP relationships. There are three ways to express CVP relationships. First is the equation method, which uses revenues minus costs equals operating income. Second is the contribution margin method, which focuses on CM per unit or CM percentage. Third is the graph method, which visually displays revenues, costs, and the break-even point. CVP assumptions. CVP relies on several simplifying assumptions. First, revenue and cost behavior is linear within the relevant range. Second, costs can be separated into variable and fixed components. Third, selling price, variable cost per unit, and fixed costs remain constant. Fourth, units produced equal units sold. These assumptions make CVP a powerful planning tool. Let's move to Section 2, Break-even point and target operating income. Break-even point. The break-even point is the quantity of output where total revenues equal total costs. At this point, operating income equals zero. Break-even helps managers understand the minimum performance needed to avoid losses. Break-even using CM per unit. Break-even in units equals fixed costs divided by contribution margin per unit. This tells us how many units must be sold to cover all fixed costs. Break-even in revenues. Break-even in revenues equals fixed costs divided by the contribution margin percentage. This is useful when a company tracks revenue targets rather than unit sales. Target operating income. Managers often want to earn more than zero. They want to meet a target operating income. Required units equal fixed costs plus target operating income divided by contribution margin per unit. CVP transforms profit goals into operational targets. Target net income and taxes. When income taxes are considered, we must convert target net income into target operating income. We divide target net income by 1 minus the tax rate. Then we use the target operating income formula to determine required units or revenue. Profit volume graph. The profit volume graph shows how profit changes with volume. The point where the line crosses zero identifies breakeven. The slope of the profit line illustrates the sensitivity of income to volume changes. Now we will talk about CVP for decision making in section 3. Advertising decision. Managers use CVP to evaluate whether increased advertising is worthwhile. Advertising raises fixed costs. If it increases sales sufficiently to raise total contribution margin, the investment may be profitable. Price reduction decision. Managers also analyze whether reducing the selling price makes sense. A lower price reduces contribution margin per unit. To remain profitable, the company must sell more units. CVP quantifies this trade-off, setting target prices. CVP helps managers determine the price needed to achieve a required operating income. Managers reverse engineer price based on volume, cost structure, and desired profit. Section 4. Sensitivity analysis and margin of safety. Sensitivity analysis. Sensitivity analysis is a what-if technique. Managers change assumptions such as price, cost, or volume to see how outcomes shift. Spreadsheet models make scenario testing fast and accurate. Margin of safety. The margin of safety measures how far current sales exceed break-even sales. It can be expressed in dollars, units, or percentage. A higher margin of safety means lower financial risk. Section 5. Cost structure and operating leverage. Fixed versus variable cost structures. Organizations face a choice between higher fixed costs and higher variable costs. High fixed cost structures have greater risk but also greater profit potential at high volume. Operating leverage. Operating leverage measures how sensitive operating income is to changes in sales. It equals contribution margin divided by operating income. High operating leverage magnifies both gains and losses. Section 6. Multi-product and non-profit CV. Sales mix and multi-product CVP. When companies sell multiple products, break-even depends on the sales mix. CVP assumes the sales mix remains constant. Managers create a bundle reflecting typical proportions to compute break-even. CVP in service and non-profit organizations. Service and non-profit organizations also benefit from CVP. They identify an output measure such as patient days or student credit hours. When revenues come from appropriations, managers still apply CVP relationships to understand cost behavior and performance. Now we will talk about contribution margin versus gross margin in section 7. CM versus GM, contribution margin equals revenues minus all variable costs. It is used for CVP because it highlights cost behavior. Gross margin equals revenues minus cost of goods sold. It focuses on product profitability and competitiveness. Contribution margin is better for CVP analysis. Let's summarize Chapter 3. Cost volume profit analysis helps managers understand how costs, prices, and output shape profitability. By mastering contribution margin, break-even, target profit, sensitivity, operating leverage, and sales mix, leaders can make smarter strategic decisions. CVP is a foundational tool for both healthcare and business management. This video is adapted from Datar and Rajan's Managerial Accounting, Making Decisions and Motivating Performance, Pearson Education. Thank you for watching this Mastering MHA MBA chapter on cost, volume, profit analysis. Be sure to like, share, and subscribe for more advanced MHA and MBA educational content.